Hello, everyone, and welcome to today's webinar. I'm really excited to introduce a friend of mine, Max Eisner, who has his own consulting and accounting firm, Max Eisner Consulting and Accounting, aptly named. Today, we're obviously going to be going over the accounting and taxes for full sole proprietors, which I think is really exciting. Even though taxing isn't always exciting and tax season may not be the most exciting in the world. So yeah, I wanted to introduce you to Max. Just so you know the format, we will go through the presentation and then we will have a question and answer period at the end. We do have quite a few people here today, so we ask that you keep yourself muted. And if you do have questions at any point throughout the webinar, just type them into the chat and we'll go through them all at the end. So I'll stop talking here and hand it over to Max. Thanks for coming in, Max.
Thanks, Justin. Thanks for having me, and thanks everyone for joining here today. So as Justin kind of mentioned here, today we're looking at accounting and taxes specifically for sole proprietors. That is what we're mainly focusing on today. And as I understand, we have a lot of current and past students, so a lot of them come out of CanScribe looking to become a sole proprietor. So I thought going over the accounting and taxes and the main issues that they may face would be a great session for today's webinar. So going over the slides today, there will be a lot of information today. So hopefully there's something for everybody. And if you have any questions, as Justin mentioned, please put them in the chat. And then there's some time at the end to go over any of those questions. Otherwise, if there's anything that you wanted to discuss further, any kind of bigger topics or questions, I'm always available for a chat outside of this webinar, and I'll make sure my contact info is available at the end of this session. So let's get going here. Grab a coffee and let's learn some accounting and taxes for sole proprietors. So a little bit about me, as Justin mentioned, my accounting practice, Max Eisner Consulting and Accounting. But about me, I'm born and raised in Kelowna, and then I moved to Penticton for about 6 years to get my CPA. Recently, in 2021, I started my own accounting practice as I really wanted to help new small businesses or sole proprietors on the accounting side, but as well on the financial and strategy aspect. So how I help is I'll sit down with sole proprietors, go over what their business is and what they're looking to do with their business and help them with that business development, but as well as the financial consulting aspects of it. Specifically on the accounting side, as I do also run an accounting practice, so I will do year-end taxes or financial statements, anything on that side, but specifically I am focused on the realtor industry, trades and contractors, and as I mentioned, new small businesses I'm very focused on as I enjoy helping businesses develop. So now I wanted to discuss a little bit about sole proprietors specifically. There are a lot of questions on what exactly is a sole proprietor. I get that a lot, or what is a sole proprietor, even because people are unfamiliar with that term. So the way I describe it is just an unincorporated business operated by an individual. So really even something as simple as like a side gig or anything like that, where you're making money on the side, you would be then considered a sole proprietor. Or if this is your full-time job, but you're not an incorporated business, you never formally went through a lawyer or a website to make a formal business, then you are a sole proprietor. The difference kind of between a sole proprietor and a corporation is you assume all liabilities personally, meaning if for whatever reason something went wrong in your business, then people sue you directly as opposed to your business. As well on the tax side, as opposed to needing to file a formal corporate tax return, you can put everything through your personal tax return, which has its benefits, but also has its drawbacks, which we'll discuss a little bit more later. So here are the first few things I like to discuss for any sole proprietors, but really any people looking to have their own business. I do kind of have a list of just general tips, something to keep in mind, and I'm sure some people have heard these before, but it's always good to go over and just keep in the back of your mind if you're ever starting your own business. So the first one is keep everything separate. Make sure to have separate business bank accounts, credit cards, lines of credit compared to your personal. And this is for a couple reasons. Really, the first one is it's easier to just keep everything organized. You can keep everything for business in one section, everything for personal in another. The second is easier to just track how well your business is doing and your spending. And if you need to make adjustments to your business plan or the financial side, then it's easier to track what exactly is personal, what exactly is business, and then even decide if it's the business side where you need to adjust spending or create more income, or maybe the personal side you need to budget better for, which kind of brings me into point 2 here, budgeting, but budgeting specifically for taxes. So I say keep 30% of your net income for taxes. If you're a sole proprietor, unlike if you're an employee working for a company, you don't get any income tax deducted off your monthly paycheck. Whatever you receive is the gross revenue. So I always say keep 30%. And if you're registered for GST, which we'll talk a bit more about later, keep 35%. While I do say this is quite conservative, that's a pretty high number to keep. I'm a bit more of a conservative person. So most people are typically in a 25% threshold for federal and provincial taxes. So I say 30% to be a bit more conservative. But if it ever comes down to it and someone's curious about the exact number or a more concrete estimate, I do provide accounting estimates to get a better number for budgeting for tax purposes. But if you need a general number, I normally go 30%. Next one, retention to keep all receipts and accounting documents for 7 years. This is just for CRA purposes. They can go back 7 years and audit you. And if they ever do, you want to make sure you have those records handy to provide to CRA if they ever want to look at anything like that. And the last one is goal set. So whether this is a side business or your full-time business, whether you want to do it for a couple of years or you want to do it for the rest of your career, it's important to have a side business or goal setting, sorry, because even if it's short, medium, or long-term goals, we want people to be knowing where they want this business to go. So a lot of times people start the business without projecting those goals. So this is just one way I help. When I sit down with my clients, I like to discuss what is the purpose of this business, what are you doing with it, and what are the goals as well. Afterwards, then we like to reflect back and hold them accountable for those goals and see if they achieved it. If not, why not? What can they do differently? Did their own goals change? Or if they did, that's great. What do we want to do going forward with this business? So now some very basic tax considerations. As most people are aware, personal tax deadlines, April 30th. If you're a sole proprietor, those deadlines do shift a bit. As normal, any kind of amount you owe in tax still due April 30th. However, you do get a bit of an extension on filing those taxes. So again, a normal person who just works a job or as an employee, everything's due April 30th. But if you're a sole proprietor, you don't need to file until June 15th. There are a couple more criteria you have to meet to hit that June 15th deadline, but almost every sole proprietor meets those criteria. So that gives you a bit of an extra window if you're a little bit disorganized or need additional help getting your taxes together. And again, that's why having that accounting estimate, if you think you owe taxes, you can pay what you think you would owe by April 30th, but then take the extra time to file it by June 15th. Something I wanted to discuss a bit more was GST. If at any point in a year, so any point in a 12-month period, you have more than $30,000 in revenue, you would need to file for GST or register for GST. The criteria for registering changes how quickly you hit that $30,000, but my typical biggest concern is if over a year, a calendar year, you have over $30,000, you report that on your tax return, then you will see you owe GST and you would need to register for it at that point. And when you file that tax return to CRA, they'll see that you made over $30,000 and expect you to be registered. So at any point you get over that threshold, you would want to register and then move forward. The other thing I wanted to discuss is there are benefits of registering early. You don't have to wait to pass that $30,000 threshold in order to register. The biggest benefits or the industries where it might be beneficial is if you're starting your own business, but you have a lot of upfront costs. How GST works is if you're registered, you need to take 5% of your sales and give that to CRA, but as well, any GST you pay as a business, you can claim as an input tax credit or an ITC, which would you would receive back from CRA. So if you have a lot of upfront costs, you can just claim all of those right away and register early, and then get that money back on any GST paid on any of those upfront costs before you start making money, and then you can get a bit of that money back. As well, if you are registering for GST and you forgot, you can backdate going 1 month back or further if needed. So if this is coming up and you think you're required to register for GST or should have done it earlier, there is the option to backdate at least 1 month. Now let's go into specific accounting for sole proprietors. Here we're going to go over different accounting aspects and terminology. It will likely vary from quite basic to quite complex, so I imagine there might be some questions here that I'd be happy to discuss further. The first one I wanted to go over is the difference between a capital asset and an expense. The traditional approach to looking at everything is anything purchased is an expense, where that might not be true. And the way a capital asset versus an expense is treated for tax purposes is quite different. So the way I look at capital asset versus an expense is broken down into the categories here. This isn't formal tax terminology, but it's a good way to categorize which is which. So first one to go over is what is the use? So any type of expense is just a one-time use, whether it's like meals, insurance, accounting fees, office supplies, anything like that. Those are all very normal types of expenses, whereas a capital asset is something a bit bigger, where it's like property, vehicles, equipment, anything that you would be using for year over year or long term. Even something like a computer or a computer screen, television, anything in that kind of area as well is typically listed as a capital asset over an expense. And then if you're unsure on where it falls, I use the threshold of $500. If you have something below $500, every time I would typically expense it, even if you think you might use it for a longer term. A common example here is something like a hammer or small tools. You can expense those immediately just because the cost of them is so insignificant to CRA that it's not worth keeping as a capital asset. And then on the other side of that, anything more than $500, you might want to assess if it's a capital asset. You can still have expenses more than $500, but it's worth debating if it should be a capital asset or an expense. Last one, the difference is how these two are treated for tax purposes or the deductibility. Any expense fully deductible in the year that it's incurred, pretty simple there. Whereas if you have a capital asset, it doesn't get fully deducted. It only gets partially deducted each year based off a CRA tax rate. So for instance, if you bought a business vehicle, those are deducted at 30% each year. So you would take 30% of the total price of the vehicle and be able to deduct that each year. And as the price of that vehicle or the value of that vehicle goes down, it's just 30% of the remaining value of the vehicle. Now I wanted to look a bit further into expenses specifically, as I think one of the most common questions I get are, what expenses can I deduct for my business? Like, is this deductible or is it not deductible? I like to frame everything with, if this was a legitimate expense for your business, then it should be deductible. There's no area around why it shouldn't be. If you are paying money for your business, then it should be deductible unless it's a capital expense, as discussed in the previous slide there. When you're actually reporting it, if you're registered for GST or PST, you want to make sure you're only reporting the net amount. As briefly discussed, GST, that extra 5% you pay, you can remit directly to the government to get refunded. And then lastly, any types of meals and entertainment, while they are deductible, they're only 50% deductible. So This can range from various things. I mean, meals are pretty simple. Any type of client meals where you sit down with them to chat, or even anything such as coffee, anything like that, only become 50% deductible. But also entertainment, if you're doing something a bit more on the promotional side where you're having entertaining guests as well, only 50% deductible. The next, probably most significant question I get is business use of home, especially during the COVID years. People are working from their home office a lot more now. And specifically as a sole proprietor, there's a couple criteria you need to hit in order to claim this deduction of using your home office for business purposes. So the first one is not listed up here, but as long as your home office is your principal place of business, or you used your home office as a space to earn business income or meet clients. So as long as it's a principal place, you used it to earn business income or used it to meet clients, which is a pretty broad criteria to meet. So if you hit any one of those three, you can start claiming this deduction as a sole proprietor. So the way I phrase it here is you need to have a home office, which makes sense. And then you need to be aware of the square footage of your total home or apartment, and as well as the home office. This can be a rough estimate. It doesn't have to be down to the foot, but as long as you have a pretty strong guess as to what percentages, that should be fine. And then there's a pretty long list of expenses that you can deduct against your business income, which includes utilities, just heat, electricity, internet, mortgage interest. So you note if you're paying the mortgage, you don't get to deduct the principal amount, but you do get to deduct the interest amount, which I always find interesting. Property taxes and house insurance. The last one there is repairs and improvements to the home office specifically. You can also deduct if you're improving the kitchen or the bathroom or anything like that, doesn't count. But if you're working on that home office specifically, then as well, that would be deductible. Automobile usage, this one depends on your type of industry that you're in, where it can be very valuable to use. Again, like I deal with plenty of realtors, so realtors driving around to clients' old houses or clients' new houses. There's a bunch of expenses to be deducted if you're using your personal automobile. So again, kind of similar to the business use of home, it's tracked as a percentage of business kilometers driven compared to your total kilometers driven throughout the year. So you need to be aware of those numbers. You need to have what your odometer was at the beginning of the year and the end of the year, or a strong estimate, as well as how many of those kilometers was used for business purposes. The expenses that you can deduct include gas, which makes sense, repairs and maintenance, which do include car washes, which I think a lot of people enjoy. Parking, that is probably the most common one that is missed, as depending what city you live in, you even downtown Kelowna, you pay for parking consistently. So that's an important expense to deduct, as well as car insurance. So when I discussed using business kilometers, if CRA were ever to return and fight back on the amount that you deducted and wanted more information on how many of your kilometers were for business and where exactly you drove, they do require you to have a mileage log. I know a lot of people either use an app on their phone, or if you're using QuickBooks, QuickBooks also has that kind of availability to just track trips very easily. So as long as they can see the date on which you drove, your starting point and your ending point, which would give you how many kilometers you drove, that's all they require. But they would want to see some sort of mileage log. Again, they do require this, but this is only if you get audited and they came back and looked at it. So now I wanted to discuss some other considerations that I think might be relevant. Sorry, just one second here. All right, so some other considerations that might be relevant, a bit on what I do for sole proprietors is just discuss other issues that they run into. So the first one is bookkeeping. So what we're looking at here is an extensive Excel sheet that I typically provide clients if they want to try to do their own bookkeeping. I understand the benefit of that. Any person starting their own business or anything like that, the expenses for bookkeeping likely aren't there, or the budget to pay for a bookkeeper probably isn't there. So I will a lot of times provide them with this kind of sheet. If you're familiar with Excel at all, it's pretty easy to use. Even if you're not, it can be quite easy to use. So what I like to do is I just, and if you can follow along with later pointer here, hopefully, you fill out everything in blue here, which most people know their business name, business number, which would just be a GST number if you have it, and then a little bit about your business. And this is just so you can file your tax return very easy. As well at the bottom here, if you're using a home office or if you're using a personal vehicle for business use, as discussed, those are right there. And then besides that, all you do is fill out the bottom highlighted yellow here as what was the expense, just a simple description. How much did you, what was the total? What was the GST amount? So we can take that out, as well as what was the code. So here there's a bunch of default codes, pretty much every type of expense you would run into, including if it was for home office or auto as debated. Everything's right here. And then if you have something really weird, there's a couple others where you can just write in exactly what that was for. And then you just scroll down on this sheet, type in all your expenses for the year, and that's all I need to fill out your tax returns. Because on the next slide here, this is how it gets automatically calculated and provided to me. It provides kind of an income statement or a report that shows exactly how you did for the year and categorizes everything for your accountant. So it would look exactly like this. And then you don't have to do anything in here. It's all automatically calculated. So it gets a nice clean version to put directly into your tax return. As well, on the right side here for the auto and home portions, again, automatically calculated exactly what should be reported on your tax return. So if anyone wants one of these types of Excel sheets to help get organized, again, my contact information will be available at the end of this presentation, and I'd be happy to share it with you if you wanted to do your own bookkeeping. Another consideration is what I call desirable tax amount. So most people try to pay the least amount of tax possible, which is completely understandable. You don't want to pay CRA money that you don't require. So that's why we spend a lot of time talking about how much of an expense you can deduct or what expenses you can deduct and anything else that's deductible. But the way I phrase it is desirable tax amount. So if you want to increase or decrease taxes, there's arguments for both. And really, it just depends on what your goals are for life and your business. And from there, you may want to strategize your personal tax return, which can just require some planning. So right now, we are getting into the 2021 tax season as we look to file all our personal tax returns. While you can't report any expenses you're incurring now to reduce taxes for 2021, there's still a way to reduce taxes if you don't want to pay the amount you think you would owe. The most common way is contributing to your RSP. Even though 2021 is over, CRA allows you to have a 60-day window after 2021 or after a year to contribute to your RSP and deduct it in 2021. And that way you can reduce your taxes owing for 2021 if you're paying too much taxes and you want to decrease that. The flip side of that is increasing taxes. Now, why would you want to increase taxes? What's the purpose of that? Biggest one is if you're looking to buy a house or buy a property in the next even 2 to 3 years. If you're working with a mortgage broker or a bank in order to buy a house, they will look at your personal tax returns for the last 2 to 3 years. If you have your own business and you are incorporated, or even if you have a sole proprietor, you might need to go through a mortgage broker and show your financial statements from your sole proprietor or from your business to help show that you can afford a higher mortgage if that's what you're looking for. But either way, they typically look for the last 2 to 3 years of tax returns. So you can imagine, even if you're not looking to buy a house today, or a condo or an apartment or whatever, in the next 2 to 3 years, then you might think, okay, how much do I want to show on my tax return? Do I want to show more income in order to get a higher mortgage when the time comes around for me to buy a property? The second one, a bit less common, but still common for some people, is if they want to buy investment properties. Again, showing that amount of income where you can have enough income to supplement two mortgages or have an investment property. And then the last one is create RRSP contribution room. Again, a little rare, but if you've ever maxed out your RRSP contribution room, which depending on where you're at in life, it's more common, then you might want to increase taxes, which would increase earned income and increase your contribution room. One more big question I get from sole proprietors is incorporation. When's the right time to incorporate? A lot of times, if you're a sole proprietor just starting out, doesn't quite make sense to incorporate. You want to wait until you have a decent amount of income coming in, where you can supplement the additional expenses that come along with incorporation, as well as use the benefits that come along with incorporation. So on the right side here, there's a couple cons to incorporation, which really are increased filing, as you would have to do a T2 corporate tax return. As well, for legal, you have to do an annual report every year for your corporation. And that's just another thing that needs to be filed. As well, what goes along with that, increased professional fees, as you have to pay an accountant likely to file your corporate tax return. As well, you might be either paying a lawyer to help file your annual return, or even if you file your annual return yourself, it still runs you just under $100, I think. So there are increased fees. So again, as I kind of discussed, you want to make sure you have some sort of income coming in before incorporating, just because you want that income to be worthwhile. And on the pro side, it limits the personal liability. So as we discussed at the beginning of the spread presentation, the personal liability, if you're a sole proprietor, it's all on you. If someone does sue you for whatever reason, if something goes wrong in your business, then people legally can come against your personal assets or anything else you own personally. However, if you have a corporation, this limits your personal liability. If someone sues your corporation for anything within the business, they likely can only sue for what's actually in your corporation. They can't come up after anything that you own personally, unless like there's something more extreme to the case. Again, I'm not a lawyer, but that much for sure, you will be limited on your personal liability side, which really can just be a relief to some people to make sure if they do have some sort of significant personal investments, there is a benefit there. The other benefit to incorporation is the small business deduction, a much lower tax rate. Again, as kind of discussed earlier, most people in the 22 to 28% threshold for personal income taxes, something in that ballpark. If you have any income in your corporation, you're taxed at 9%. So a pretty significant decrease there. So as debated, once you start making some significant income, then there's a huge benefit to using this tax rate, because the savings you get on your taxes completely outweigh the additional accounting and legal fees you have to pay. One more thing I wanted to go over is installments. Again, if you're sole proprietor, you may owe a lot more in taxes around April 30th. When the deadline comes, then you would have otherwise, if you were an employee, as employers will deduct payroll tax off your paychecks each month. Whereas here, you just get your income and you report it as is, and that's kind of it. So if at the end of the year you owe more than $3,000, and you did in one of the last 2 years, then you will need to pay installments. There's no way around that. So how installments kind of work are, there's a calculated estimate and you need to pay them quarterly. So that's by March 15th, June 15th, September 15th, and December 15th. And then the installments are calculated. It's a bit more of a formal or a complex calculation, but it'll just be based off your 2020 or 2021 taxes owed. So again, this really only applies to people once they start making some significant income in their sole proprietorship and they're over that $3,000 threshold for one of the last 2 years plus this year, then installments becomes a factor that they need to be aware of. And if you miss paying installments, that's when you owe interest and penalties to CRA. And the thing I hate paying the most is additional interest and penalties to CRA, as typically it's almost always avoidable. One of the last things I want to go over, if people are becoming sole proprietors or run their own business, it becomes a lot more common that you get audited by CRA. A lot of times they can be very simple. Something as simple as they just need to see an additional document or a little bit of support. Even discussed with the vehicle usage, they would just want to see a mileage log, and then that's it, you're good. Or they might just want to see a utilities bill for your business use of home, anything like that. So it's pretty simple most of the time. Sometimes it can get a bit more complex. So the tips that I give is get help of a professional if needed. A lot of times it's important even to just get the help of a professional to just look at the letter quickly and make sure you're not missing anything. Make sure you get a good understanding of exactly what CRA is looking for, and so that you can respond appropriately. The next one I have is respond to the letter by the deadline. So any letter you would get from CRA would come with a deadline as when to respond by. It is important to respond by that deadline, or else you start to get yourself into a lot more trouble, and it becomes a lot more work to reverse CRA's ruling on their assessment or their audit and get the case reopened up. If you're preparing your own letter, make sure you do it with the case number and information provided by CRA. On the left side here is a mock-up version of what I would provide if someone required me to do a CRA audit for them or provide them with additional information for a client. So as you can see here, I make sure in the heading to have the case number clear, as well as the name of the person and the reassessment, as well as a letter explaining what we're doing here and all the following documentation requested by CRA. The last thing I like to do is follow up with CRA. So if you hire a professional, they typically do this for you. That's what I would do for you, is make sure I follow up with CRA. At this point, since COVID, they have been well behind on everything, including audits and assessing tax returns. So I follow up within a couple of weeks to make sure they have our case, that they've logged it, but likely it takes weeks, even months, for them to review the case and reverse it. But as long as they've had it in their system, then the ball's in their court. You're no longer responsible. And so I always find it important to follow up, make sure they have everything they need, or at least that they've gotten our response. That way it's on them. The second part to a CRA audit, if you did want to do it yourself, easiest way to do it is type up that letter, kind of like I showed in the previous slide, and then you log into my CRA account. As we see, I logged into mine, and you go into the Submit Documents tab and submit the letter with the case number, as I've kind of shown here. So the last thing is, if you do want to do it yourself, I completely understand. There's a lot of very simple audits that come through, so we kind of went over the best way to do it, and then you just submit this letter here, make sure you follow up, and kind of go from there. The last thing you want to do is not respond or do anything like that, as you can get into issues, as I've kind of mentioned before. So this is the biggest one, where really a lot of the times it's such a simple solution, but if you don't respond, if you put it off, or if you don't do it correctly, it can get you into a lot more trouble than what was initially expected. So I think that's about it here for me today. I want to thank everyone's time. That took me just over a half hour. That's great. So I'd love to hear any questions that anyone has. Justin, I think you're going to moderate some questions for me.
Yeah, absolutely. Thanks, Max. That was awesome. Ton of information there. Obviously, if you have questions, please type them into chat and we'll go through them. I wanted to talk about that first spreadsheet that you kind of walked through for kind of doing your own taxes and things like that. Max will provide that to you, so you have that. Just reach out to him. I'll put his email into chat for you. So just send a quick email.
Last slide here. I got it all.
Yeah. Oh, look at that. Don't even need to put it in chat. He came prepared today. Yeah, so it's a super helpful tool. I mean, I love Excel. Max obviously loves Excel, and you can do so much with it, especially when you've got the right tools, and Max kind of created that right tool for you.
So if we wait for any questions here, as I kind of said, if you want to follow me on social media, a lot of what I discussed today, I tend to post on either Instagram or on my Facebook page. So you can find me on either of those. If you want an extra connection on LinkedIn, I'd be happy to add you on LinkedIn. Find me there and feel free to add me. Or if you have any accounting or tax concerns or questions, so my cell is up there as well as my business email. Feel free to send me a text, shoot me an email. I'm happy to set up a time to go over any kind of questions or concerns you have. For any potential client, I typically do a free 30-minute consultation to go over exactly what they're looking for and exactly what they need.
Awesome. We've got our first question here. So do you charge GST on international invoices when you're working with a company that may not be located in Canada, maybe the States, Australia, something like that?
Good question. So if you're charging, if you're based in Canada, but you're charging an external supplier. Am I reading that correctly? Like someone outside of Canada?
Yes, yeah.
You need to, I'll go into this a bit more detail probably off of where this question was initially going, but if you're charging GST, even if you're charging like an Ontario person, someone in Ontario, someone based in Ontario or something like that, you need to charge their GST rate. So by that stroke, if it's someone external outside of the country, you don't need to charge GST. But if you're charging anyone outside to a different province or territory, you need to be aware of that province or territory's GST rate, as you need to charge that amount, even if you're located in BC.
Awesome. Another question here. Should you expense receipts? When should you? Wow, I can't read. When should you keep your expense receipts? So I'm still studying. Can you only use expenses after you've started working?
If you have a sole proprietor, I guess is kind of where I'll base this question off. You can, if you're having some income come in, you can expense that earlier on, even if you are still studying. The benefit to that is if you have a loss in your sole proprietor, that can deduct against any other income you had in that year. So kind of depends what the expenses are and if they're related to a business. But if they are related to a business, you can deduct them even if it's more than any income you've earned.
Now that question made me have a question.
Yeah, go for it.
I obviously don't know the answer to. If someone started their sole proprietorship, let's say halfway through their studies, would they be able to write off part of their tuition as an expense for the business?
You wouldn't write it off as an expense for the business, but if you're paying for your own tuition, that comes in another form, and you just can deduct that already against any income you've earned, as well as that can be carried forward. If you don't have enough income to deduct it against, once you start earning income, then you can deduct those tuition credits. So yes, you can deduct it, but not as a business expense. But it will be deductible anyways.
And that's more the important part, I think.
I agree. Yeah.
For you. So thanks again, Max, for coming in. That was super helpful.
All right. Thanks for having me, Justin. It was great. And thank you everyone for listening.